Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. 21 weeks ago, part of my musings on the market were thus, and I quote, "We may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 223 to 299, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering." End of quote. Concentrating on this big bear channel right now, I also added more recently onto my daily chart a further late December 2022 to mid-February 2023 bearish Andrews pitchfork. I'd previously highlighted this in dark blue, as it really captured the bearish angle of attack of the market. However, 2 weeks ago, the upper tine crossed over the lower bright green bear channel line, creating a cusp, and we had a break higher as the bearish pressure generated by the pitchfork gave way, and we have such a resurgence higher, something I'd cautioned about on last week. I will retire this pitchfork next time. Now, overhead resistances are in a stratified layers and seemingly quite dense at the moment. What we have seen is a move over the congestion area 238 to 242 that contains the March 2013 high at 240 and the declining short medium moving average, also currently 240, up to test the February 2013 high today at 247 and pierce it but not close over it. Above this there is a congestion band 250 to 255 with a 2013 high at 253 within it. The medium moving average is declining into this area, currently at 256. Then there is a small congestion area, 258 to 260, with the 2011 high within that at 258, followed by a bit of a deserted area, emptiness, up to some heavy looking congestion between 267 to 270. Now that is enough on the upside for the moment, as it still leaves the question open here as to whether this is just a recovery in an overly bearish market, or if the attempt down in late May and early June to the 50% absolute Fibonacci line at 219, which is highlighted in purple on my daily chart, whether this move down triggered the beginnings of a new bullish move. It's too early to say anything more than this is a bullish recovery, but I would keep a close eye on the moves higher just in case it becomes more. London, UK feed wheat. Now, 6 weeks ago I pointed out, and I quote, "The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. Initially, I was not wholly wedded to this pitchfork, as neither the upper tine, currently at 174.60, nor the lower tine, currently at 139.85, had been tested. However, in the absence of anything else, I was minded to watch this pitchfork, and so far it has been pretty good at indicating the bearish angle of attack." End of quote. This pitchfork continues to be excellent at showing the bearish angle of attack of this market, especially between the upper and middle times, until this week, when we saw prices exit through the upper tine and start to fondle the 50% absolute Fibonacci line at 180.5. This break higher up through the upper tine was caused by one specific series of supports, which I detailed last week, and I quote, "We are now approaching potentially some significant supports below. This is not the July 2021 low at 164, even though I would perhaps add that this market low may have been influenced by this support. It is a congestion area formed over March to April 2019 between 161.95 to 165.75. I am not sure how the market will treat this congestion, given how it took 2.5 bit weeks to punch down through the 50% absolute Fibonacci line, but is the next support zone below. Hence it should be respected." End of quote. The bearish Andrews pitchfork, which had been great at showing the trend lower, failed at testing this block of support and formed what could be seen as a possible mini reverse head and shoulders pattern from mid-May to mid-June. It's a really small one. The break higher also coincided with the neckline of this pattern, currently at 178.05, crossing the upper tine late last week. Now, while this mini pattern has seemingly broken the pitchfork, it has not as yet started a significant move higher. but rather sticking to the 50% absolute Fibonacci line and the nearby September 2021 low at 181.70. I'm afraid that I do not expect this to carry on much longer, and the market may likely have to make a decision whether to continue higher or repair the pitchfork. You see, coming in from above, we have the short medium moving average, currently 186.35, with all the potential bearish pressures this may bring. However, should the market punch up through the descending moving average, then it's fairly clear area topside, up through the lesser Fibonacci lines at 192.70 and 199.20 to meet and test the declining medium moving average, currently 202.10, which is just ahead of the first real piece of stratified resistance banding overhead between the March 2013 high at 205.05 and the 2022 low at 206.5. By then, we may know whether this market, like some of the other wheat markets, would have formed the beginnings of a possible descending scallop pattern.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.